proud to present session 4, Loans After the Bubble, Top 10 Things You Must Know About Mortgages. And here to discuss this for us and lead us in the direction is Brian Atallian. So Brian, take it away.
Hi, Brian. For those of you who don't know me, I am Brian Atallian. With an A, not with an I. For those of you that are Italian. I am a native Delawarean. I was born here, but my dad was in the Air Force, so I had the pleasure of transferring from state to state to state to state, to school to school to school, starting things over and over again. I think pretty much every child should have to do that after. As a child, I hated it, but I think that it certainly makes you a more well-rounded person. After being moved around everywhere, I moved back to Delaware and attended McCain High School. Went to college in Delaware. During my time in college, I worked at MBNA. And for those of you that have been in this area, you're absolutely familiar with the employer MBNA. Very involved in the community, a fantastic employer. I would not be where I am today in my career without my experience at MBNA. For those of you who know MBNA, their involvement in the community was substantial. The experience level that you gained while working there was tremendous. And you also know that you also worked your butt off when you were there. So there was never a time that you were going to progress in the company without working overtime, working 3 jobs. But if you were willing to do that, they rewarded you handsomely for it. My time there moved throughout and ended up in the mortgage division. In the mortgage division, their training from my standpoint was fantastic. From credit, understanding credit, how to extend credit, the mortgage process from A to Z. And while at MBNA, an existing coworker of mine approached me and said that he was leaving and going to a company called Pike Mortgage. At that time, I said, "Yeah, you're crazy. I had this promising career at a big company," and this was before Bank of America bought them. So one day I said, I'll check it out. I'll sit and talk to the owner of your company. I came in, I was dressed like this, and I had my little portfolio, and I was ready to present myself to the owner of the company. His name was Wayne Moses, and I walked in his office in a little townhouse-looking thing in Wood Mill, and his first words to me were, "I don't know what you're wearing, but you look silly." So that was my first introduction to the mortgage world. And his next words were, "You don't really have to talk. You can go downstairs and start trying to work, and if you make it, you make it." So that's how I started doing mortgages outside of MBNA. Worked both jobs for a little while, and about 6 months later, the owner, still owner of Pike, came to me and said, who are you and what are you doing here? I said, "Well, you hired me." And he said, "What's your name?" I said, "Brian Atallian." He said, "That's a weird name." I said, "Well, you write my checks." And he said, "So you're the one that's doing all the business?" I said, "I am." "Well, come upstairs and talk to me." Okay. But that's as easy as it was to get started in this business when I got started. I didn't need a license. I didn't need to have the education level that I had from working in MBNA. I didn't need to be registered anywhere. I didn't need anything. So for 6 whole months, I was doing loans to the tune of 20 to 40 loans a month with no repercussion to me, with no licensing, with no fees, with no skin in the game, with no nothing, which sounds kind of odd for where we are today. As you can see it on the screen there, I'm currently licensed in Maryland, Pennsylvania, New Jersey, and Delaware. As a company, we're licensed in Florida as well. The story that I told you, coming in and working with Pike Creek, at that time we were a company of 6 individuals. We're now a company of 40. We're licensed in 5 states. We have an office in Dewey. We have an office in Russia. We have an office here. We have an office in Pennsylvania. We have an office in New Jersey. We have an office in Florida. So all of this has come about, and if you've been listening to the people before me, at a time that was probably the worst recession minus the Great Depression that we've had, we've grown tremendously. And we've had to, because otherwise what they also had talked about in the previous presentation was the small brokerage shops and that sort of thing no longer exist. And we're back to kind of being a too big to fail type of situation. We are the largest correspondent lender in the state of Delaware. We have some unique lending circumstances that allow us to conduct business a little differently. We do handle everything in-house, our processing, our underwriting, our lending, everything says Pike Creek on it when we go to settlement. Everything's happening on my walls, and after the loan is then packaged and done, like they alluded to, we do end up selling the loan to Fannie, Freddie, FHA, VA, whoever it may be. So we have a lot more involved today than we ever did when I got started. When I got started, it was ridiculous. This is the question that the lady asked. She's not here, but she had asked about the Dodd-Frank Act. This is one of the biggest counterparts that have come out of the Dodd-Frank Act is our NMLS licensing service. I'm licensed in there. My background check is in there. My fingerprints are in there. My credit history is in there. All of this, and this is on a yearly basis from each state that I'm licensed in. I have hours of continuing education that I have to do for each and every state to maintain those licensing. If there's anyone that wants to go on and type my name in there, you can. It'll tell you if there's anyone that's ever placed a complaint against me. And if I've ever been charged with any sort of crime, it's in there. It doesn't tell you my detailed credit history, but it does tell you that I'm good enough to at least keep my mortgage license. And the compliance involved that is now handled through the NMLS. That is not something that was handled before. So the question in the previous session was a unique question because it was answered the complete opposite of what I think. The response from Ed and James, I think it was that they don't think that the Dodd-Frank Act has had any real impact in the mortgage lending industry. And it has, absolutely has. We are very heavily regulated. My licensing fees on a yearly basis for every single state right now are about $7,500 a year. So before I do a single thing, I pay my licensing and my continuing education and everything else that has to be done. And that is all because the NMLS has put this into place, tracks it, keeps everything that was never done before. So for them and their response, I think that it's had a huge impact to benefit the consumer, to benefit all of you that either you have had a house, you will have a mortgage, you're going to. This keeps the people that should be doing business the right way in the business, and the people that either can't afford it or should never have done it to begin with are out of the business. If I do anything fraudulently, financially, I will never be able to do mortgages again. I will never have a license in any single state because the MLS will ban me. So it's put a lot of checks and balances in place that may not have never ever been before. Actually, we're not, especially when I'm sitting downstairs and the owner of the company doesn't even know who I am. So the NMLS is a huge resource, and if you just Google NMLS consumer, you can go in there, you can type up any person that you want, any bank that you want, any company that you want, and check all of their employees, what state they're licensed in, all of that. So one of the things that they talked about earlier as well is some of the different loan options. Today, you have to be able to fit the entire criteria. You cannot have the income and not have the credit. You cannot have the credit and the income and not have the assets. You have to have every single piece of it. One of the problems that they talked about in the previous presentation is with loan products and with stated income loans and with no doc loans. You told me that you made $57,000 a year. Well, you really only made $17,000 a year, but you told me something that made you qualify. So as far as I know, the loan was good. Or you have a 740 credit score. I don't care if you have a job. I don't care if you have $1 in the bank. I'm doing 100% financing as a no documentation loan. I can even change your credit report, white out your credit report, certain things that should not matter to the underwriter. That is the way it used to be done, and that is precisely why we're as part of the reason why we're in the situation that we're in previous years. So one of the things that has come out of that is your debt to income ratios. when you're calculating your debt to income ratio, you have a front end and a back end debt to income ratio. What matters is both. Before, it didn't matter. Again, I would just say your income was X amount of dollars and you're good to go. Today, your front end debt to income ratio is your housing expense. And what I've got up here is your total housing expense, which is your principal, interest, taxes, insurance. That's your housing expense. If there's any sort of condo association dues or any other homeowners association, that's part of that. But in this situation that we're looking at, this diagram, your total monthly housing expense is $750 a month. Your gross income is $2,850. So if you divide that, your front end debt to income ratio is 26.32%. In today's environment, it's perfectly acceptable. But what we're also worried about is your back end debt to income ratio, which is any other revolving debts that you have, any car loans you may have, installment loans. You take all of that, which in this diagram amount to $400 per month, or $1,150 total, divide that again by $2,850 in monthly income, it's a 40%, 40.35% debt to income ratio. Those are the numbers that, the beginning parts of what matter today when you're obtaining a mortgage. You come into me and you have a 57% debt to income ratio, and you have 800 credit score, you have $1 million in the bank, I don't care, you're not getting a mortgage. Because your back end debt to income ratio, you're going to certainly get a mortgage, but that for that particular house you're looking at is not going to happen. So you have to look at something different. This is one of the pieces that has changed dramatically again with the documentation that's required of a loan. Every single loan today is a full documentation loan. There is nothing that I can say, well, they've been there for 6 years. Well, guess what? It's going to get checked. I'm going to find out how long you've actually been at your job. Your job will be contacted in a form of verification of employment. I'm going to find out how much money you have in the bank. I'm going to find out what money has been deposited in the last 60 days. I think it's over $500. I have to verify all of that. So your full documentation loans is the only option today when it comes to documentation for a mortgage. And again, this is just kind of the beginning part. I know this is very simple math, and I'm sure everyone here is certainly able to comprehend it. So does that all make sense as far as debt to income ratio is concerned? And I mean, at any time, if anyone has questions, feel free to shout them out, whatever. It's, I'm certainly not, I don't want to take up all the time here. But continue with those debt to income ratios. With those loan products, and the only loan products that there are today is your FHA loans, your USDA loans, VA, DSHA, which is your Delaware State Housing Authority, down payment assistance programs. If you're a first-time home buyer looking to buy a house for the first time in the state of Delaware, and every state has one, but in this case, I'm using Delaware as an example, an $8,000 tax. It's a loan that you can borrow to buy a home for the first time. It is paid back when you refinance or sell a house. It's at a 3% interest rate, so it does accrue interest. That is something that has changed. It used to be $10,000. It used to be no interest. There are some forgivable programs, but through the Delaware State Housing Authority, it's a very specific program. Conventional loans and jumbo loans. What you've seen, one of the things that with all of these, for the most part, except for your DSHA, these numbers are a guideline. There are some more make sense types of underwriting these days. Happens more so in your government loans, especially with the VA loan. They're looking out for the veteran, but at the same time, the VA will look at a loan that has a 45% debt to income ratio when the borrower has an 800 credit score, when the borrower has assets and reserves in excess of 6 months and 12 months. It's more of a make sense underwriting. If I presented a file to my underwriter and I said, this person has a 47% debt to income ratio and a 620 credit score, the first thing he's going to say is, you're not an exception for me. But I have a borrower that's a 740 credit score. I have a borrower that's got $45,000 in the bank, that has months of reserve, that has the ability to afford the house on an ongoing basis for at least the next 6 months. So in case you lose your job for 3 months, for 6 months, whatever it may be, they have the ability to sustain that, to make more of a make sense underwriting. DSHA is not one of those things. DSHA, they say that your maximum debt to income ratio is 45%. It is not going to go higher than that. 45.0001 doesn't matter. You got to find a way to get it below that. Otherwise, go use a different program. Another place that you don't have much variance there is your jumbo loans. Jumbo loans are certainly more expensive. The interest rate's higher. The money down is more, and they don't deviate. When they're lending out $800,000 on one loan, you don't see any variance from the underwriter. For the most part, there's always a little bit of an exception to the rule. But your jumbo loans, they're generally packaged and sold not to Fannie and Freddie or government institutions, they're sold individually to private investors for the most part. So that there's not a whole lot of make sense underwriting. You either fit in the box or you don't fit in the box. That makes sense? Those maximums, and again, that's your front end debt to income ratio, your back end debt to income ratio. The reason why there is 41, VA doesn't care whether your front end debt to income ratio is 41. It can be 41, 41. So it appears you can afford the house. And DSHA is the same way. So for the most part, it's jumbo. But that's why you're only seeing one total debt to income ratio there. One of the things that the gentleman before me were talking about was a 228 product. They made it sound like it was the devil, and it's never been heard of. It's just an ARM. Okay? There was what's called a 228 product and a 327 product. All that had to do with was your prepayment penalty, whether it was 2 years or 3 years to pay that one off. So it was a 2-year ARM. It was adjustable after that. It was still carried the same 30-year amortization. Yes, the thought was you could certainly refinance the house at some time because the future value is going to continue to go up. But when you've got a 327 or a 227 on the problem really got into place when there was the prepayment penalties that were in place for these loans. But they, all in all, they're just your standard ARM, which people still use today. There's a 1-year ARM, there's a 3-year ARM, there's a 5-year ARM, there's a 7-year ARM, there's a 10-year ARM. There's even a 15-year ARM. With these ARM products, there's more checks and balances put into place for what they can go up to. You're no longer allowed to have prepayment penalties on any loan. It doesn't matter if it's an out-of-the-box jumbo loan, it makes sense, government, FHA, VA, Fannie Mae, Freddie Mac, Ginnie Mae, does not matter. You are not allowed to charge a prepayment penalty on any loan, period. And so with these 227s, 328s, these ARM products, when you had these prepayment penalties, people ran into a problem and they couldn't refinance without paying a $7,000, $8,000 prepayment penalty. I mean, so they had to stick in these loan products. And as we got closer to that bubble, it deflated. And they couldn't refinance. There was no loan products available. So these products are no longer available. One of the loan products that, if you know anything about mortgages at all, I'm sure you've heard of the option ARM or the pick-a-pay ARM. It's probably the single culprit of probably the entire problem. That your pick-a-pay loan was 4 payment options, was a 15-year loan, and you could have this every single month. 15 years, 30 years, interest only, or a neg-am loan. Neg-am means that if your payment is $1,000 per month, they allow you to make a $600 a month payment. So now your balance itself, because you're not even making the interest of $1,000, you're only making a payment of $600. That extra $400 is being tacked onto your loan every single month. Well, there was also prepayment penalties with those loans. You couldn't refinance them. You couldn't get into another loan. As the value started to drop, your balance continued to go up. You were not able to refinance. You weren't able to do anything. It's also an ARM that was a monthly adjustable interest rate. They spoke on earlier about what they did with prime, what they did with some of the loan interest rates, and how quickly they went up 17 straight raises, which they did, and that directly affected this pick-a-pay loan. That was the very first loan product to go away. And a lot of the banks and lending institutions that are no longer in existence are the ones that offer that product. One of the main reasons why Countrywide is not in existence anymore is because of that loan. It was the number one loan they sold. 40 and 50-year AMs, it's not a bad thing. I mean, it's obviously it takes longer to pay the house off, but at the same time, you're still making progress on the balance. But today, again, I touched on this earlier, but full doc loans. I need 2 years tax returns, W-2s, 1099s, any scheduled real estate that you own. If there's any Schedule C income, any Schedule E income, these are all schedules that come along with the tax returns. If there is any self-employment at all, I mean, it's 3 years tax returns. 1 full month of pay stubs, not Well, here's a pay stub that's for the last 2 weeks. Now I need 1 full month of pay stubs and probably more. 2 months of bank statements. This is the 2 months of bank statements is one of the biggest pain in the butt parts for you as the borrower, because if we have a settlement date that's longer than 45 days away, I'm going to need new bank statements. Well, those bank statements, if you have money being transferred between checking and savings, like normal people do, I have to show both sides. Where you transferred it from, where it came from. So now I need double documentation, because you say, well, I gave you that. I knew you gave me that, but I also need the other side because there's this on there. Or you sold a motorcycle, a $5,000 motorcycle. I need the bill of sale. I need everything that transpired. I need a copy of the deposit slip, I need a copy of the check written to you. All of the money has to be documented. And this was, again, directly coming back from the Dodd-Frank, but more so Patriot Act. Patriot Act in terms of one of the things that came out of September 11th was the amount of money that was being funneled into the United States via real estate. So anything that's over 1% of your normal income being deposited into your checking and savings accounts must be documented. And it is a lot of documentation if you move money at all, or if you receive money from self-employment. If you're a normal W-2 person, it's usually pretty easy. But bank statements are a huge annoyance to the borrower. All loans are fully amortizing. There is no neg-am loans. There is, you can have an interest-only option, which is for a shorter period of time now, but there is no neg-am option. Reverse mortgages they've been around for a long time. They are actually an excellent tool. Reverse mortgages to access the equity in your home. In the event that you're unable to work, you need the income, you have bills you want to pay off. You go to the older than 65, which only anyone who's older than 65. So, but if you do have equity in your property rather than selling it, you don't have any heirs to the property too. Reverse mortgages have a kind of a bad stigma, but they're an excellent tool that can be used in the right situation. Interest only is an option, and the biggest one that has helped many homeowners is the HARP program. Again, something that has come out of Dodd-Frank, not directly Dodd-Frank, but what's happening in the financial industry is the HARP loan, and it's a Fannie Freddie product that allows you to refinance in the event that your home is underwater, which a lot of people bought in 2005, 2006, 2007, and then 2008, 2009, 2010, we went back the other way, and you bought at the height of the market, and you have a 6% interest rate. Well, it's not fair. You should go refinance. The government has come up with this HARP program. It's a phenomenal program. I don't want to waste too much time on it, but we might have to talk to anyone about it. But it is allows you to refinance. In some situations, there's no maximum that you're loan to value that you're allowed to refinance up to. So technically, it's 125% loan to value. So if your home is worth $100,000 and you owe $125,000, you would normally never be able to refinance that loan. Well, with this program that does end at the end of 2015, they're going to take it away. It allows those individuals that are underwater to refinance. So everyone that says this, it's unfair. Now there are still some loans. If you have that pick-a-pay loan, that loan is not owned by Fannie or Freddie. It is unfair for you because you do not fall under the qualifications of the HARP program. So, or if your loan was after 2002, 2009, you're not HARP eligible as well. But all in all, a fantastic product that's come out that's allowed people that are underwater to refinance. Questions? No? No? Good. One of the other parts of this is your down payment. Your down payment has increased. I used to be able to do a loan, believe this or not, at 110% financing. So when you bought a house, I could do your mortgage. If you bought the house for $100,000, I could let you borrow $110,000. Just because. Not because you wanted to build an addition, not because you wanted to pay off debt, because the product was out there. And it still fell into a stated income program. You couldn't do it as a no doc, but you could do it as a stated income. Now we've got much tighter restrictions. Your conventional is a maximum loan to value of 97%. That being said, it's really 95%. There are some particular programs with first and home buyers that allows you to go to 97%, but 95% is the real maximum loan to value on conventional loans. FHA is 96.5. That it used to be a lesser amount down. They've increased it a smidge. also triple your fees for an FHA loan. So your FHA loans are your most expensive loans you can possibly do. Your monthly mortgage insurance is 3 times what any other loan is. The upfront mortgage insurance premium that you pay on any government loan, as an example, on a VA loan, it's 2% unless you've reused it, but there's no mortgage insurance on a VA loan. On an FHA loan, it's 1.75% of your loan amount that's financed as part of the loan, but your monthly mortgage insurance rate is 1.35. So it's on a $200,000 loan, it's about $287 a month more, where it used to be 0.5%, which is about $110 a month. So your FHA loan is tremendously more expensive. The two best loan products out there are your USDA loans and your VA loans. Oddly enough, I don't know that anyone's actually a veteran in here, but oddly enough, those 2 loan products are they're the lowest foreclosure ratings of any loans we offer today. And what's odd about that? It's 100% financing. Because the credit score requirements have always been more. They're looking out, there's restrictions in there, looking out for the veteran, they're looking out for someone that's looking to buy in a rural area, which USDA is changing that map supposedly in October, because places like Middletown that used to be USDA or is currently USDA eligible, now where Todd lives is considered a rural area, which last time I guess with Middletown is not rural anymore. So that's changing in October, which means that USDA loan is no longer going to be available down there. They'll move more farther south, but they are changing those maps. There are now maximum loan values. I used to be able to do 125% financing on a cash out refinance. So if you wanted to pay off bills, do home improvements, whatever it is, I could do 125% of the appraised value of your home. Well, that's not the case anymore. Cash out maximum is 80%. Keeps equity in the home. Your cash out, your rating term refinance is paying off just your mortgage. You're not paying off anything else besides possibly rolling in your closing costs. You're not paying off any car, you're not paying off any credit cards, you're not paying off any vacation home, you're not doing anything else then that falls under a cash out refinance. So you're limiting the amount of equity that people are able to get out of their home, which in most cases is a good thing. Even though I can refinance your house and save you $1,000 a month, pay off all your credit card debt, pay off everything you have, then you just try to charge it all back up again, and now you have a high equity position and on the same debt. So these restrictions have been put in place except for the HARP program that allows no cash out on that. It's only meant to pay off the balance of your home. Make sense? Perfect sense. I touched on this earlier, but my job now is much harder than it used to be, and the biggest thing that annoys you as the consumer is the amount of documentation that I need. Again, it says disclosure, disclosure, disclosure. If I can put more up there, I would have. It would say disclosure, 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 disclosure all the way across the wall. Everything must be documented. My application, when I first started, was 26 pages. It is now 57 pages on government loans. It's about 43 on conventional loans. There's undisclosed debt forms. If there's anything you don't have that doesn't show up in your credit report, there's a form that you sign now that says that you disclose all of your debt to me. So if you went and bought a car at, say, Deals on Wheels, they go on financing, it's not going to show up in your credit report. You're supposed to disclose that to me. You're going to sign a piece of paper saying that you did tell me about it if you have it. Your 4506T, I need copies of your tax returns as well as W-2s, as well as 1099. I'm also going to contact the IRS and execute a 4506T on every single file. Does not make sense to me for a silly reason to make sure that what you gave me matches what they have. Why would I just get it from them? It's not asking you for it. Well, the process is that I have to get it from them, or from you, as well as get it from them. Compare them when they match. Congratulations. If they don't match, and this is the number one source of mortgage fraud, was someone made $50,000 a year, so I have to qualify to put 1 in front of their tax return. That's what they give me. I made $150,000 a year. Buy the house. But on every single file, 4506T is executed. Your good faith estimate is now, used to be 1 page, it's now 3 pages. The disclosure to you is different. In some cases, it's better for the consumer. For some cases, I think it's actually more confusing. A lot of your fees get grouped together rather than individually broken out. I have to provide to you homeowners counseling. It doesn't matter if you're buying, if you're refinancing, cash out rate of return, doesn't matter. I have to let you know within 10 miles of wherever your home is that I'm refinancing or that you're purchasing, that you have a housing counseling option. All within a 10-mile radius. If you say don't do it, I don't, but I'm supposed to go over each one of those, what it means to be a homeowner, that I provided you with this documentation. You have to sign a piece of paper that says, it's now about 12 pieces of paper of every location that I have to disclose to you. It doesn't matter that you own 50 houses. It doesn't matter that you've bought 20 houses in your lifetime. This is what we have to do now. Patriot, I can check your name against the terrorist list. See if you know any terrorists. This list is actually kind of silly in my opinion nowadays because there are so many names that are on this list of John Smith, Bill Jackson. It's silly that we even use it anymore. But if it shows up, if your name shows up on this list until it gets resolved, you're not buying a house. Equal credit opportunity, just as another disclosure form has to be sent over. The Social Security verification, I have to verify with the Social Security Administration that you are who you say you are. You gave me your driver's license, you gave me your passport, you gave me documentation, but I also have to contact the Social Security Administration to verify you are who you say you are, that is your address, and there's other stuff that comes back. Even though your credit report shows it, even though your tax return shows it, we have to verify all that through the Social Security Administration as well. There's a credit score disclosure that's now 6 pages. You have 3 credit scores, your TransUnion, your Equifax, and your Experian. I'm going to try and speed this up a little bit. That it now takes 6 whole pieces of paper for me to disclose to you 3 numbers. And what could, not what affects yours, but what could affect your credit score. Again, more disclosure, more disclosure, more disclosure. I touched on this earlier, large deposit verification. Anything that's over generally $500, you have to verify where the money came from. You say, well, I just found it. Well, that's great. Give me the deposit slip that shows cash on it. And then I have to back that out of what I'm able to use. I can't use cash. You said, well, I have a suitcase, I have a safe at my house. It's got $10,000 in it. Well, that's great. Go deposit it, come back to my office in 3 months, and then we get started. Money that's coming from mom, dad, brother, sister, aunt as a gift, I need their bank statements, their check to you, your deposit slip, your bank statement going into your account. So there's a lot to verify. Transfers, checking, savings, I need both sides. You cash out bonds, I need when you cash those bonds, they give you a receipt. I need the receipt, the deposit slip, I need a copy of everything that went into it, and a bank statement showing it went in. Everything gets documented 5 times over. So the large deposit verification is one of the biggest things that is a hassle to you as the consumer because you're allowed to have cash. There's nothing wrong to say you took money from a terrorist and tried to buy a home with it. But that's part of the process. Kind of went through this. The only thing is, on every single mortgage, this is everything that is required from start to finish. And title work is obviously required on every single transaction, and appraisal is required on every transaction today. Before I could do a stated value of your home, we can do off a drive-by, we can do all kinds of other stuff. Well, guess what? Those days are gone. Full appraisal, as you know, a full appraisal on the property. Come in, take pictures, measure the property. There are also, one of the things that come out of this document and everything else, the appraisal has a lot of guidelines built into it. That's not my job, it's more like yours. But there's, on that side of things, I have restrictions as well. There's net adjustments and there's gross adjustments that are in these appraisal reports that say, you have comparable 1, 2, and 3, well, versus your subject property. If they exceed certain thresholds, it doesn't matter if she did a great job doing the appraisal. It doesn't matter if there's actually fraud in it. I can't use it, doesn't matter. It's a 46% gross adjustment. I can't use it. Go find other comps. Guess what? You're the one not buying the house. The appraisal doesn't work. Your survey, your verification and down payment money, we've kind of talked about that. So most of the slide we've really covered. Before I even kind of get into credit, I want to, it took me a little while to get through that, but through the first part of this, is there any questions that anybody has kind of looming on what I've gone over already. I've kind of gone over a little fast, and so if you have questions, please feel free to shout them out anytime. Because this is good information. It's also kind of boring if you're not bored already. But your credit ratings. There's 3 different: TransUnion, Equifax, and Experian. Your credit ratings go from a 350 to an 850 credit score. I tell people this all the time. It is so important to know your credit. For people that know me, my friends, whoever it is, I say, if you want me to pull your credit, I'll pull your credit. I don't care. Because I think it's good that you know your credit. You know what's on there. You know that the balances that are reported. You know if there's something that was mistakenly reported as a late payment by accident or on purpose, or they just didn't have the money. I used to go off of the government-suggested website to obtain this information, which is annualcreditreport.com. Well, and it was great until the government got involved and added restrictions to that. Because they said, well, if you're going to provide that same information for free, they actually have to pay for it in some fashion. You know, it's your credit report, the information is being provided, so annual credit report changed it, and now they'll give you your credit history, but will not give you credit scores. So I switched to services like Credit Karma and Credit Sesame. They are way better. They're free. They give you your credit scores. And this is something that I learned kind of by chance from talking to a friend of mine, Curtis Henderson with Plus Credit, who's a credit repair person that I deal with. And he turned me on to these 2 sites because, again, the annual credit report used to be a great option, but these are better and they are free. And I highly suggest you go on there. If anyone wants me to pull your credit, I certainly will. But it'll give you notifications. The borrowers that I deal with that have this, they know every single time I pull their credit, and they call me and they say, Equifax Mortgage Services just pulled my credit. That was me. And you'd be surprised how much information is on your credit report that you don't realize is on your past employers, your past addresses, aliases. A friend of mine in the audience, his name is Josh. Like it's Joshua. So when he signed his application, it was a name affidavit that said Joshua. It was also Josh. All of this comes onto your credit report as well. So it's very important to know what is in your credit report for sure. This is where I wanted to kind of spend a little bit of time, a little bit more time, is giving you an idea of what is in your credit score. Your credit score is, everyone knows and thinks that the payment history of your credit score is the most important part of your credit. By the percentage, this is 35%. It is. The biggest part is not necessarily your payment history, because there's nothing that you can necessarily do about your payment history. You can't go back, and if you paid a bill late when you were 19 years old, you can't go back and change it. It is what it is. You can obviously, going forward, make sure you pay your bills on time. But a bigger part of your credit score is, they have it up here as the current debt. It's actually called your credit utilization. It's your balances versus your credit limits. Five credit cards at $5,000 a piece. You're revolving $5,000 on one. You're 100% utilized on that account. The other 2 are paid off, and they're free and clear. You're automatically going to be hit for somewhere between 15 and 40 points because your utilization on that one card is at 100%. The optimal situation is that you're at a 38% or less utilization. So what you should do is take those balances and if you're financially able to spread these things out. Sometimes it may not be the right situation either. But as far as credit is concerned, you take these debts and you spread them over. Now you lower your utilization, and your credit score, instead of being hit from 1, is actually getting better. You're utilizing the credit properly that you have. The length of your credit file, it is important, but you can't go back to when you're 18. I have a Discover card that I've never closed. I hate Discover. Sorry if it works there, but the interest rate's like 49% or something like that. It was my very first credit card. I got it in college. I bought a $3,000 mountain bike with it for some dumb reason. But it was my very first card. I can't go back to when I was 18 years old and reopen that account. I would lose all of that credit history if I closed it. So I keep it open. And every once in a while, I'll use it just to keep them from closing it on me. But that's the depth of your credit file. Types of credit. it's the best thing you could possibly do is have every single type of credit. A credit card, car loan, mortgage, student loan. Well, it's kind of silly because you're not going to get a student loan. You just have good types of credit. But you do want to have your mortgage. You do want to have 3 open trade lines. You do want to have, which are revolving debts. You do want to have a car payment if it makes sense.
They ask you when you're filling out, what sort of accounts do you have on a debt basis, but also on an asset basis. Do you have a checking account? Do you have a savings account? I don't know who has savings accounts. Do you have any idea why they ask you that question?
Try and look at that and take in your assets that you have. So, do you have anything in the bank? And before it was as simple as you answering the question. Yeah, but $6,000 in my check on my savings account. Okay. Well, now you need to verify it, obviously. But what they're looking for there is to have your assets in the bank and know what kind of borrower you are. Do you have anything in the bank at all? And that they're looking at that from a credit line standpoint to say, the credit line we're going to extend this person. Yeah, they make money, but they have no money in the bank. They make $100,000 a year, but they have $1,500 in the bank. Well, there can be a problem here. And when they pull up your credit history and see what other revolving debts you have, it'll show that as well. You have $100,000 in your check in your savings account. Generally, people don't kind of make that number up. Generally, if you have it, you have it. So that's what they're looking at. We're looking at that open line they're looking to extend to you. It's how much is the line they're looking to extend. So this is, the point of this is not necessarily your payment history, but more so the utilization of your debts. I think is more important than even your payment history. Obviously, everyone goes and pay your bills on time. But to keep those balances at no more than less than 50% of the credit limit is very, very important. Real quick credit rating scores. I want to kind of jump over this, but 680 has always been kind of a benchmark since I've been on mortgages as a pretty darn good credit score. As you can see here, 680 says it's good. The reason why I showed you this as if you have below a 580 credit score, you're not getting a mortgage. Not from me, not from Billy down the street, not from Wells Fargo, not from Chase, not from anybody. You are not getting a mortgage. Before I could do a mortgage down to a 400 credit score. In some cases, I could go lower than a 400 credit score, which is crazy to me. Because you had to work really, really hard to have a 400 credit score. And you tried on purpose to get that. But the point of me showing you this slide is this. Actually, I'll come back to that in a second. Your credit score is so important today. That's why it's so important to work with, in my opinion, someone like myself, because it's me, I think, but at least someone that is a professional, that is in the industry, that knows how to help improve credit, that knows how to get you from point A to point B. This here, what I wanted to show you is if you had a 680 credit score, which everyone can probably agree is a pretty good credit score, you're putting 20% down on your home, which is a pretty darn good down payment. You're right here. What that means is you're paying 1.5 points as an extra fee to buy this house, even though just because you had a 680 credit score. Up here, this says you're paying 1/4 point, which is really next to nothing. But you're being penalized from a 680 credit score with 20% down, no mortgage insurance involved. You're automatically either paying 0.375 higher in interest rate, or you're paying a 1.5% on your loan amount as a fee. Again, why it's so important to work with someone like myself, to work with someone that knows how to improve credit, to get you up here where you're not being penalized and you're in that 740 score range or in the next bucket and get out of here. The slide that I skipped was up here, and I know this is an ugly slide, so it'll be fun. I wanted this diagram in here. The state of Delaware, the average credit score in the state is 632. Sounds pretty low, but the national average is 637, so we're right there. And you can see, I don't know where everyone's from, you can see your other states that are in there. The point of showing this is if you had a 632 credit score, and again you were putting 20% down, you are now down here. And now you're paying 1.5% higher in interest rate. So instead of the going rate today, let's say it's 4.5%, you're paying 6%. Or you're paying me another 3.25% of your loan amount. So in other words, $7,000 and change on a $200,000 loan amount as a fee on top of that.
That fee goes to you, right?
I wish. No. These are, as you can see, the FICO / loan to value delivery fees. Delivery fees means when you sell that loan to Fannie Mae, Freddie Mac, FHA, VA, whatever it may be. This is mainly for conventional loans. Your government loans are a little different. But credit scores, so very important when you're trying to buy a house and you're trying to take that next step and say, well, I mean, you're here. This may mean a difference between buying a house of your dreams at $200,000 or being forced to buy a house that you really don't want because you need a place to live. So now you're in the $150,000 range because the interest rate bumped you out of that price range. My job is to sit and figure out how to make sure you're getting the best possible loan you possibly can. And in my opinion, it's done via credit. This never used to be the case. Again, you had a 740 credit score. It didn't matter. You're no doc loan, 100% financing. You got your house, you moved on. These are delivery fees that are on every single loan. It's not with my company. It's not with Wells Fargo. It's not with Chase. It's every single one. Help preserving your credit. These are some pointers that I think are important. Obviously, number one is I'll touch on all of these, but pay all your accounts on time. I mean, if you don't know that, then someone has never really talked about credit at all. But obviously, that's the number one part of your credit score. Limit the accounts to your credit. Everyone gets so scared when people say, "I want to pull your credit." It doesn't really have the impact that people think that it has on your credit score. An inquiry can be a credit inquiry. It could be a score inquiry. It could be a mortgage inquiry. They're all different. They don't have. If you have really bad credit and you have collections, you have judgments, you have these items, yes, inquiries are going to hurt your credit because there is a problem. There's a reason why you're getting your credit pulled. There's a reason that you need money. You have good credit. All you're doing is shopping around. It's not going to hurt your credit. So when people say, I need to pull your credit for the credit card, or I need to pull your credit for the mortgage, there really is, the impact is very minimal. And you're applying for a discount or for a mortgage because you need more credit. I talked about this earlier. Don't let your revolving balances exceed 50% of the credit limit. That is, in my opinion, the most important thing. Obviously, pay your bills on time, but that is. Don't close any accounts. It talks about that. Knowing your credit. And the last one I have in there is get a secured card. If you're trying to build credit, you don't have credit, you're having a tough time. A secured card is going to report to your credit report. It's a good thing to get. They hold on to X number of dollars you deposit with them for a period of time. Once you've made your on-time consecutive payments, they give it back to you. It's probably the best way to start getting credit because it's hard these days, not only from my standpoint, from mortgages, but from all standpoints. Car loans, they're pretty easy stuff, but credit cards, mortgages, loans. So this is my contact information. I know I kind of skimmed through, not necessarily skimmed, but I could have gone a lot deeper on, especially some of the credit stuff. I did not want to run out of time just in case there wasn't any room for questions that people had, and I'm more than happy to answer any questions, to spend any time with people afterwards if they'd like. And there's certainly a lot more that I could have gone over today. There's a lot here, there's a lot that's happening in my industry, and I hope that I didn't bore you too much because the mortgage world can be a little boring. But was there any questions anyone had?
What's the investment market look like these days as it relates to mortgages? You used to be able to get a ton of them, and it's limited to 10, and 4, and this and that. Where is it? What is it? And what's the recommended amount now these days for investment properties?
The investment world is extremely difficult. Credit scores have to be higher. Your down payment is higher. That being said, buying an investment property today is fantastic. Prices are in line. Your interest rates are in line. The rents are, I don't know that I can't say for sure they're at an all-time high, but they're probably 1.5 times what they normally could be because it is so difficult to get a mortgage. Required down payments going to be 20% down. With 20% down, you're going to pay a premium because you're only putting 20% down. So you're going to pay about 1/4% higher with 20% down. It used to be an investment property you needed as little as 5% down. It's now 20% down. If you put 25% down, your fees, these fees, these fees reduce substantially with a 25% down investment loan. So your down payment that's required is a lot more. The credit score required to put down is a lot more, or a lot better to have. But if you can afford it and you have the money to invest, and what the moves that have been put into place to make it that much harder to buy investment properties, to become an investor is actually a good thing, but it does require more of an initial down payment. And your reward is that your rents are fantastic. I'm doing a mortgage right now. Actually, Brian Hadley and myself are, where he's buying a $67,000 property in the city of Wilmington. It's a 3-bedroom. This place rents for $1,200 a month.
$1,800 a month.
I have 12, but if you, it rents for $1,800 a month. There's a lot of people in this house apparently, but it's still $57,000 or $67,000. His mortgage payment is $410 a month. Now, he's a young kid, it's a low sales price, so the down payment is not necessarily a lot in that situation, but he's still coming up with $15,000, $16,000, actually $18,000 to put down this $57,000 or $67,000 property. But he's making $1,000 a month, over $1,000 a month. So if you can afford the down payment, buying an investment property is the way to go. You're allowed to have up to 4 properties. There are some exceptions with certain lenders that you're allowed to have 10 investment properties, but now you're going to expanded underwriting. So Fannie Mae and Freddie Mac guidelines say you can have up to 4 properties before you're not able to buy another one. That's something new. It used to be that you could have 100 properties. Fannie Mae and Freddie Mac put this in place that if you have more than 4 properties, you're not buying another one. I'm sorry?
Even with commercial bank.
No, commercial bank is a whole other ball of wax.
For the 4, maximum, are those for investments, does that exclude your primary residence and like a vacation home? Are those, that includes
It's for financed properties. You can own them if you're free and clear. That's sometimes what we'll look at is if someone, as an example, when I choose, he has a couple of properties. And if he came to me, I think it puts down 3. So the next one is fine. But after that, I'll maybe look at, he has some really good equity in some of those properties. So if there's something you want to come across and you can say, well, how about refinance this one to pay off this one? Because it goes by finance properties. But yes, second homes, investments, your primary residence. Another thing that goes into that, it's a good question by the way, that goes into that is your months of reserves. If you're going to buy an investment property, you have to have 6 months of reserves of every single finance property you have, including your primary residence. So if your primary residence is $1,000 a month, you have 2 investment properties that are $500 a month, so $2,000. You have $12,000 in the bank. Over and above, you require 20% down. So there's a lot more that goes into buying an investment property, and I had that kind of part in some of this presentation, but I was not the only one around time either. So, what else? Yes.
Aside from interest rates, usually up and down, any other rumors or whispers that you hear as tightening of credit or additional restrictions coming down the pipe that people should probably consider?
Actually, some of this has loosened from where it was. There's no discussion that I'm aware of that changes the credit score requirements are changing. The down payment is changing. If anything, it's actually getting a little bit easier. The required down payment on investment properties was 25%, so now you get 20% down. There is even a couple lenders here that will possibly allow you 15% down. It's like fitting a square peg into a round hole. It doesn't always fit. But if anything, to be quite honest with you, to answer your question, is the requirements are actually probably loosening a little bit and making it a little bit easier for people to be homeowners and or buy investment properties. Except for what I spoke about earlier with some of the guidelines on USDA. As an example, USDA, those maps are changing. And that's going to affect that. I was doing a presentation actually for Keith the other day and his group, and the information that was provided to me by the Hadley group was stats. And I was actually kind of surprised by the answer that I got when I looked through the number one area of growth in Newcastle County. And it was the area code of 19701 and 19709, which is Bear and Middletown. And I contribute the Middletown growth to a USDA loan product. People really jumping on that and knowing that it's going away because it is such a good loan product. Bear, I was very surprised, but it's a perfect first home buyer's price range. There's a lot of new businesses coming into that area, and a lot of transforming of older neighborhoods into maybe move-up buyers or first home buyers moving these areas and fixing these houses. So I was a little surprised by that. It's actually a good sign. Our housing numbers are up tremendously. Our inventory is, they spoke on this earlier, our inventory is down. So when a house pops on the market, call the housing group, call one of these three, and you say, put my house on the market. If the house is clean and the house is priced appropriately, it is going to sell in a heartbeat. So everyone that is saying, the market is crazy, there's nothing, the house is not selling, they're absolutely wrong. I mean, first home buyers, the price of $400,000, you can't keep a house on the market at $400,000. If it's nice and it's priced appropriately, it is going to fly off of the market as well as your first home buyer price range, the $200,000 to $250,000 price range. Because there's no inventory. There's nothing to buy. I think I was looking at the numbers, I think overall the Newcastle County numbers were a 4 to 5 month supply right now, which creates a normal appreciation, but it's also a low amount of inventory in that $200,000 to $400,000. Thank you. I appreciate the time, and if you need anything else, feel free to grab me after.
The website for that.
Mine?
No. The points.
Right.
No,
Credit Karma?
the one,
It's gonna be getting maybe?
no. The one that shows how many points with your different credit scores. Or interest rates, you know? Keep going. No. There.
That's not actually a website at all. And you'd probably be pretty hard pressed to find that. That is what is given to us as loan officers to when pricing out a loan and what repercussions are because of credit score and loan to value. So, I mean, you can certainly Google that. If you Google what it says there, FICO and loan to value delivery fees, I'm fairly positive you'd be able to find this information. I don't know if there's a particular website that I would direct you to. If you Google that, I think you have no problem finding it.
Any other questions for Brian? Before we shut down the day, there's a lot of great speakers in addition to the ones we had today coming up later in the week. We have Dave Tiberi as a guest tomorrow for lunch. Once again, thanks for the first day of the Delaware Economic Summit in the books. Special thanks to Brian. Let's give him a hand real quick. And hopefully I'll see all of you later in the week. So enjoy your day and have a safe evening and a safe trip home. Thanks.